What is up, everybody? I got a question from a YouTube subscriber. At least I hope it's a subscriber. Either way, they asked a question on one of my videos. If you have not subscribed, please do. Hit the bell icon, all that other bullshit. And like the video, too. But anyways, they asked a question on my scalping on a Dom video. I made it like 2 videos ago. And they were more so asking me about specific setups. Now, I'm going to read the question from the sub, but before we do that, I do feel like I am missing something. Don't you guys feel like we're missing something here? Something that could maybe go over there? Well, here's a little short video on what should go over there. Yes, that's right. Daddy Bellafury is back, and look at him. He's looking better than ever. The third rendition of... Is that the right word? I'm kind of retarded, guys. I don't know why you come and listen to me. But that's the third version of the Mike Bellafury that I've had for many years now. If you guys are not familiar with any of this, well, maybe you should watch more of the videos on the channel. But he's back. And he's looking good. I hope you guys like the candles. Makes it nice. And it says one good trade right there. So, rest easy. Now, I must say, yes, he was dead for a while. And we didn't have a picture for several episodes with him there. And I'm sure plenty of you are glad he's back. But, unfortunately, since he's back... something else did die, and that is the green visor. I can no longer wear the green visor anymore because this is all a fucking green screen. And if I did wear the green visor, well, part of my face would disappear, and then you would see the brick wall going through it. And while that might be funny for an episode, it's really not feasible. So I don't know what I'm gonna do for my fucking headgear at this point. Because a regular hat is just not cool enough. It's too boring. It ain't me. I don't know. The visor, man. Shit. So, I'll have to figure that one out. But anyways, let's go ahead and get into the subscriber's question. And again, this is on the Scalping on a Dom video. He asked me, Fat Cat, thanks a lot for one more good video. Quick question. Was all these scalps based on some particular setup, not price action? So, yeah, kinda, yes and no. Price action is definitely heavily influenced, and I got like this flow chart we're gonna look at, but it's not this cookie cutter thing that a lot of newer traders typically look for. I would say that every trade is unique. No two trades are alike. Now, they can be similar in a lot of ways, but they all have these little nuances that just make them very unique. So, anyways, he asked, again, was all these scalps based on some particular setup, not price action, that you were following when executing the scalps? You mentioned about bear bias on the higher time frame, but in this video you were trading, scalping some particular setups? Question mark. Thanks. Yeah, so let me go ahead and just pull this up right now. Okay, so here is a chart, and we're going to go over all 5 of these boxes. This is very much my trading and how I structure my trades. Now, what you got to understand is there is no cookie cutter setup. Every single fucking trade, even if it's a scalp for a couple of ticks, they're all different and unique. Now, while there are certain trades that are very similar to other trades and you can kind of like categorize them, they're still all different and unique. And there's a lot of nuance to it. So this is how I structure my trades. There's really no one place to start. So we're going to just start with techniques for high probability entries. So all of these trades up here have been tagged. So these aren't really setups. These are more so techniques to get into setups. So let me pull up the pin here. So for instance, slips has a 5-to-1 probability. Basically 5 out of 1 times it wins. Whereas mean reverts are 4-to-1s, reclaims 2-to-1s, micro range 2-to-1, completes 2-to-1s, micro channel 1-to-1, right? So these aren't really setups. Like for instance, slips, you can't just take a slip anywhere. And I'm not going to explain exactly what a slip is. Actually, I'll try to explain it. So what a slip is it's essentially a place on the depth of market where you'll see the price start to absorb and get stuck in certain areas, but there are specific areas where the market will shoot through a couple of prices really quick, and it'll do it on both sides. And typically it'll do it multiple times, and that is a place I look for on the depth of market where I can get almost instantaneous momentum. Typically, I don't ever want to have a slip zone behind me because I run the risk of the trade blowing out against me really quickly. It is more favorable to put the slip zone in front of you. So when I put the slip zone in front of me and I tag it, so what I do, I tag all of these. So when it comes to like actually tagging trades, and I talk about it in my coaching series, if you've not watched the coaching series, there's a playlist on it. You should definitely go watch it. My coaching student is tagging his trades. I think it's important that you're more so tagging specific techniques on super small time frames instead of trying to tag like very large A+ playbook setups. And near the end of the video, we're going to actually go over an actual A+ setup, which is different than these techniques. These techniques merely assist me into getting into an actual bigger setup more precisely, if you will. These techniques for high probability entries, these are more scalpy styles of techniques, but they can be leveraged into actual holds. So slips have a 5-to-1 win-loss ratio, so they're very good for me if leveraged correctly. Now, slips happen all the time, but if you're hitting them in the wrong fucking spot, well, it doesn't matter. So there's a lot of finesse to actually make them work. Mean reverts, that should be self-explanatory. So a mean revert is most of the, like if you have a bell curve, most of the time the price action is going to revert to the center of the bell curve. But when I talk about mean reverts in here, I'm not talking about mean reverts on an RTH or a composite. What I'm talking about is on a very small 3-second chart using 3-second price action or even 1-second price action. It could even be 30-second price action as well. One thing that's very important for me is reading very small time frames, because the smaller the time frame, yes, it's noisier, but if you're trying to hit precise and you're trying to scalp, it is very imperative that you're able to read the price action on very small time frames. And typically the price action on smaller time frames is a little cleaner because as you go out and expand and look at the entire session, the price action may be more random. Sometimes you'll get a bell curve, for instance, and when that RTH session creates a nice neutral bell curve, sometimes the price only goes through it up, chops sideways, and then continues up, and then it creates a bell curve. Whereas you would think a bell curve is going to have the price action dipping back and forth, testing the edges, you know what I mean? That's not always the case. Whereas if you really go down to a smaller time frame, you tend to get more of that cleaner price action. So when I talk about mean reverts, there are, and we'll go ahead and just pull this up while we're talking. So when I'm talking about, because, I mean, come on, right? So when we're talking about mean reverts, it could be a very small bell curve. I do like to reset my profile on the depth of market at times when I notice that the price is starting to chop a lot. And what's interesting is the entire session, even if it's neutral, can be it can be made off of a lot of smaller bell curves. So there's little sections, and you're probably going to occasionally see a cat float through the fucking screen. There's really nothing I can do about that. I think it's kind of fucking hilarious. You just saw Womack just hover through the brick wall across Mike Bellafury. So he may do that again. Just so you know, and that's going to be an ongoing thing, so that way we can at least get the cats and some of the shots as fucking well. Now they're just gonna fly through whatever the fuck I'm presenting. So anyways, yeah, so a mean revert could also be just chopping and there's no small bell curve or anything, and I'm just looking for it to revert to the center of that price action chopping on a 3-second to a 1-second chart. So, because most of the time price, especially in the ES, because the ES is an excruciatingly fucking choppy market, most of the time price is going to be reverting to the center. So you can think of a mean reversion as almost like gravity. I think it's always best to be hitting into the center of the chop or the bell curve. Smaller bell curve, guys, not larger ones. And, hey, quit fucking with that. Fucking asshole. So, fuck, what was I talking about? Oh, yeah, so, when price is starting to chop a lot, that's almost like gravity, and it tends to suck the price in. So it's best to, if you want to go short, to get short on top. And if you're trying to get short and you try to get short on the bottom, typically that'll suck the trade back in, and that's not going to be as clean as trying to like go into the mean and then have it hopefully pop out on the other side. Now that could be, again, a smaller bell curve or just smaller price action. Typically I prefer price action where it's visibly chopping on the 3-second chart, and try to get the trade to suck back into it, because that's what's going to happen most of the time. So therefore the mean revert has a 4-to-1 win-loss ratio, so it's works really well. Now, these statistics are subject to change at some point, because as I throw more tags into Journal Ticks, and by the way, if you guys are interested in saving $30 on Jigsaw, please use my affiliate link in the description and then use the coupon code that's in there as well. You'll get access to Journal Ticks. I've got to do a video on that one day, but that's where I tag trades to get these specific statistics you're seeing up here. So, again, the more I throw in these stats, the more this is going to get a little skewed and shit over time. But that's what they are currently. So let's talk about reclaims. Reclaims are going to be an area where maybe you see a large seller dump a fuckload of 100 lots on the ES. The market will take a huge shit, and if it goes super quick and it creates like one bar on the auction vista on Jigsaw, and by the way, auction vista is very important for me when it comes to reading the 3 or 1 second chart, and that's, again, you get the auction vista with Jigsaw. So I mean, I also use Sierra charts. I'm sure you can figure out in Sierra charts, but Sierra charts is a fucking nightmare to set up. I use both. And I have 2 computers, so Jigsaw is executed on one computer, and then Sierra's on a different computer. So my execution PC is completely standalone. I don't stream, surf the web, or nothing. It's strictly Jigsaw, and this prevents lagging or chopping. It's just a smart thing to do. But anyways, so reclaims, if you're looking at the auction vista or a 3 or 1 second chart, there'll be a quick riff of a 1 bar, and it could be spanning, I don't know, it could be 2 to 5 to 8 to 12 ticks. Typically, the price will retrace a reclaim really just as fast as it went down. So a reclaim has a 2-to-1 win-loss ratio when I'm trading into it. So they work out pretty well. But the thing is, you have to be very particular and specific when hitting into reclaims. If the reclaim's on top of a mean, then that mean might pull the reclaim. It may not reclaim. The mean may suck the trade back in. However, if the reclaim is going into a mean, then you have a mean revert and a reclaim. And if I took that trade, I would put both of those tags on that trade, and that makes it even more high probability of actually working. I don't necessarily want to use one of these techniques to get into a trade. I would like multiple factors of support. I would like a mean revert and a slip to work together, or a mean revert and a reclaim. That makes it a lot more powerful, a lot better. So multiple factors of support is very necessary. Any of these techniques standalone aren't really all that great. So when you're seeing these tags, these win-loss ratios on them, those aren't simply that tag standalone. A lot of that statistic could be from a trade that had the other tags complementing it, just so you fucking know. So some of these slips could have a mean revert tag attached to them, or it could have a micro range or a complete or a micro channel attached to them, or may not. The combination could be so many different things. But it is important. Again, any of these standalone aren't good at all, and then that would heavily fuck the win-loss ratio on them. But we know for a fact that everything except for the micro channels, which I do believe micro channels are a little bit newer for me. I do want to touch on that. So micro channels do have edge, or channels do have edge. They're very powerful. I just got to figure out, and that's a newer tag set, so that could really change heavily as I'm putting more tags into it. Whereas some of the other tags are older, so obviously when I'm adding tag sets to it, they're not going to change as drastically as the micro channel tag set. But there is edge to the channels. I'm still trying to figure that out, but I'm pretty confident of it. But anyways, and that tag may change a little bit. But anyways, currently it's a 1-to-1. Now the micro channel is going to work a bit better when you're adding other things to it, like slips and mean reverts. If for sure works really good with slips and mean reverts. And essentially it is simply when the price is channeling up on a bar chart, or the auction vista, or Sierra charts, or whatever. So price action is incredibly important for me. And the market has been channeling a lot lately. It channels all the time. There's constantly channel setups in the ES. Because what happened is the market, we did go through a market regime shift. So the market coming into the summer really started to get a lot more choppier, and it is still extremely choppy. So we have gone through a regime shift where hitting these awesome 40, 50 tick wins just don't come around as frequently as they did back when the Ukraine invasion happened. But what I'm noticing is there's a shitload of channels in the ES, and they're constantly there, and they can definitely be leveraged, but you just don't blindly take them. It's very important that the channel fits in with something. Like if you're looking at a volume point and control on a RTH, let's say the RTH session is neutral, it's D-shaped. If you have a channel that's going through the middle of it and it's setting up right on the middle of it, or it's setting up just above it, that's not a good channel to take. You want to try to hit it below the mean and time it to where it fits in, and then you have the mean assist the trade up. So again, I mean, my scalps or my trades or holds, they're so nuanced and very particular. But there's a lot of reoccurring things that can be leveraged, such as these techniques. These techniques happen all the time, every day, multiple times, and they're always there. They've always been there. So I think finding stuff on little patterns, little somethings on super small time frames, those are good things to tag, because those are typically more repeatable than some large setup that, again, we're going to go over one at the end of the video, but they're more repeatable, and they just happen all the fucking time. I mean, you can get hundreds of slips in a session. You can get a shitload of mean reverts. Micro ranges always happen, which is a 2-to-1. So a micro range is just a range. So that, for me, I could be playing a top tick, bottom tick off a micro range, but essentially a micro range is very close to a mean revert. It's a little different than a mean revert, but they're very similar in some ways. A mean revert is more so using actual profile structure, like higher nodes and shit, where a micro range is more so just price action. Then we have complete. So in that video that the subscriber was asking about, I started marking arrows in that specific video. I definitely recommend you guys go check it out, which it seems to be a lot more of a popular video than the last two. Go figure. But I talk about complete auctions in that. I'm not going to talk about them in this. If you want to know more about it, go to that video. So these completes have a 2-to-1 win-loss ratio, and these are legitimate fucking statistics, guys. I mean, how many fucking traders are pulling legitimate fucking win-loss statistics on certain shit, right? So this is like me playing poker, and slips is obviously going to be pocket aces. Yes and no, not necessarily, but they really do help substantially. But anyways, and I got so much shit to cover, I'm not going to go through this in nitty-gritty detail. Like, I am going to eventually sell material where I go through all of this with a fine-tooth comb, and it's just, that's what's going to happen. So anyways, so that's techniques for high probability entries. So what these things do is they do matter. So there is something right here. This right here is called sweet spot. I have 2 videos on sweet spots. Volume and volatility. I talk heavily about sweet spotting. I definitely think you guys need to go watch those 2 videos as well. But so oops. So volume and volatility is very important, and in my next video after this, I'm going to cover volatility. Some of you are really new. I believe a lot of people that watch my channel, most people that watch my channel are going to be newer. So volatility is a huge lesson, because volume and volatility are two fucking different things, guys. So there is a sweet spot where volume and volatility is just right. I talk about it in the sweet spot video. So let's actually talk about that right now. So volume and volatility, volume is how fast orders are coming in. If the orders aren't coming in very fast, then typically volatility, it does directly affect volatility. So, but sometimes the book can thin up. So the order book can thin up. The DOM can thin up. Order book is another name for DOM, depth of market. Sometimes, especially during rollover, or market makers are deciding to pull often. And when that happens, it doesn't take as much volume to push the market. So depending on how thick the limit orders are on the order book, if they're pulling a lot, it takes less volume to go the same distance. So if they're pulling a lot, it takes less volume to go the same distance than if it was thicker and there was a shitload more volume. So volume is definitely very important. There's good volume and bad volume. Sometimes there can be a lot of volume, but it could maybe be just, say, a bunch of 10, 20 lots hitting, but you barely have any one lots hitting. And when that happens, you tend to get trapped in the trades more frequently. And that's why I like to cut the tape up. So I have the 2 tapes, which, by the way, my 20 lot tape is now filtered at 10 lots. I think that's just important so you guys know. So I have a tape filtered at 10 lots and up, and then the other one's unfiltered. It's very important to have a healthy mix of retail and mid-size tape to have a really good sweet spot, in my opinion. Sometimes it can be mid-size heavy and there's barely any retail coming in, and when it's mid-size heavy, you tend to get more sweeping on the price, and getting filled can be a little bit harder. The market tends, you're going to start to get trapped in trades a little bit more. The market can blow out against you really quick, and then it starts blowing out in both directions really quick, and then it gets stuck, and then it blows out really quick, and then it gets stuck. So larger traders without the without retail trader lots accompanying it, does create problems to where it's not sweet, for me at least. I can still trade it, don't get me wrong. But when that's happening, I have to make specific adjustments. And some of these techniques for high probability entries right up here don't work in specific volume and volatility environments. So just keep that in mind. So depending on how that tape is flowing on the depth of market, really some of these will shine and some of these techniques won't work as well, depending on what's happening. Now, there can be another problem where the book is super thin and orders are constantly pulling, so market makers aren't very confident, so they're pulling orders all the time. And it's nothing but retail, and at that point, it's not just retail, but that's just how I name it. What's happening is larger traders have to cut their trades up, because if they shoot a 20 lot in, it may make the market pop up 3-4 ticks instantly just off 20 lots because orders are being pulled. When that's happening, it does create a lot more volatility. That also creates some sort of issues as well that need to be accounted for. Whereas when you have good mid-size and good retail and it's flowing in well, and you got like good volatility, I would say good volatility is about, when you're looking at a 3-second chart, the average bar rotation as it's chopping, because when you zoom in that much, You get a lot of chop. That's just how it is. But I want to see those bars moving about 6 to 12 ticks, and I would say that's good volatility. That's sweet. Whereas when it gets constantly pinned up in 4-tick ranges for many seconds or even minutes, that's poor volatility. And also having really low volume is bad as well. Having low volume and low volatility is extremely bad. You're going to get trapped in the trade. And as a day trader or a scalper, volatility is king. And volatility allows for you to be a little bit sloppier, and it's more forgiving. Obviously, the volatility can be so extreme, like FOMC or some shit, that you're going to experience massive amount of slip on stop. That's too much. And that, again, watch the sweet spot videos, because it's a bell curve like this. There's a point where the volatility and volume is just perfect, and that's at the top of the curve. It can be too low, too slow, or too fast, too extreme. And at those two ends of the spectrum, you're out of the sweet spot. So the sweet spot definitely affects the techniques up here. So this affects that most definitely. So for instance, slips need volatility, but slips don't need high amounts of volume. Whereas reclaims will happen occasionally in lower volatility environments. The lower the volatility, the lower the volume, the less reclaims will happen. The higher the volatility, the higher volume, reclaims are going to happen all the fucking time, and then they start to just be there. Whereas slips are more of that sweet spot area. They're not really there when it's super extreme. Yes, they are there as well. So depending on that sweet spot spectrum, these techniques and shit, they actually certain ones work in specific environments a little better than others. And this is how I'm adjusting for those different environments, because when the volume and volatility are shifting, you must have different approaches, and that's where these techniques and shit work to make those adjustments. So volume and volatility are important, and volume and volatility are going to constantly be shifting throughout the session as well. It's obviously higher on the open, and then as the afternoon comes through, it shifts, and it can hit areas where it slows down and gets low and slow, and then for several minutes, 10 minutes, and then it can start to pick up when it blows out of that area again. And every time that is happening, you got to constantly be shifting and adjusting your techniques and stuff to get into the trade, and you got to account for that. That's kind of what that really does make trade. That's why trading is difficult, is because you got to constantly account for that and constantly shift for that. And you should have techniques like this to make those adjustments. But you also need to be aware that, hey, shit is shifting, so maybe I need to do this or that or stop doing this. But it's not that simple. Things are obviously about to get more fucking complex here. So we also have, let's see, let's go down to patterns. Let's actually go to context building over here on the right in the red box. So we have context building. What is context building? So there's something called tracking, which is at the bottom. Tracking is me constantly tracking where all the slips are, where are the mean reverts, where are the reclaims, where are the micro range, where are the completes, where are the micro channels. And I may not take a slip, a mean, a reclaim, or any of that bullshit Because if it's not in the right area and it's not being complemented by multiple factors of support, which I think is extremely crucial, like multiple factors of support, I tagged trades for a very long time with multiple factors of support, and the win-loss ratio on multiple factors of support was substantially higher. I don't remember exactly what it was, but it was massively fucking higher. So multiple factors of support. I don't use that tag anymore because now I know that, hey, multiple factors of support work really fucking good. So now that I know that, I'm always trying to nail trades with multiple factors of support. And this is a thing, guys, like my trading is pretty fucking complex. I think trading as a whole is complex. And this is why I think when people say you should be able to explain your edge in a couple of sentences, I think that's a load of shit, because if that was the case, then the failure rate wouldn't be so high. But anyways, let's fucking continue. So tracking, I'm constantly sniffing out shit. And I'm just looking for stuff. And what it's doing is when I'm tracking things, I'm building out a narrative. Right? So I'm building out a story in my head as things are happening. I may not execute a trade without appropriate narrative. Having good narrative is extremely crucial and very important. And the thing is, the volume and volatility will definitely affect the narrative as well. So the volume and volatility, I mean, that's going to affect narrative. And so is tracking all of these, smaller things like the slips, mean reverts, reclaims, whatever, the blue box. So I'm tracking shit, and tracking goes to narrative. And then you can see how like things are starting to point to other things, and now it's just starting to look like this mess. It's going to look like a mess when we're done with it. So let's talk about profile structure and price action. These are, and I probably didn't put everything. Just a side note, I don't think everything I do in my trading is here. A lot of it is, but there might be shit I'm forgetting to put in these fucking boxes or certain things, but whatever. Hopefully this clears some aspect of my trading up, because it is a bit mysterious for you guys. So profile structure and price action. I would say these things are going to complement each other. They're not quite tracking, but profile structure and price action, I believe, in my opinion, price action and profile structure go hand in hand. You can't have one without the other. Price action, when I'm talking about price action, I'm talking about the bars moving on a 30-second chart, whether you're using candles or bars. I prefer bars over candles, or the auction vista. Like, price over time is huge. Good old-fashioned price action. Price action is what's going to create profile structure. And depending on what's happening, for instance, if we have, let's just say we have a neutral profile. Well, that neutral profile, it can be created off of very different types of price action. For instance, you can have a bell curve where the price came from the bottom, got stuck in the middle, and went out the top, and there it goes. It never ping-ponged through it, but it creates a good-looking bell curve. Whereas you can have another nice neutral bell curve where the price actually starts whipping through it. Sometimes you have a bell curve where, yes, it comes in from the top, and then it gets stuck in the middle, and then it tests the bottom. Ticks the bottom multiple times, and it's staying below the center point. But the thing is, you still have a good-looking bell curve. All three of those examples were built off different price action. And the thing is, in that last example, if it's staying mostly below the bottom, the midpoint, and it's bottom ticking multiple times, and most of the price action is below the midpoint, well, then I know that at some point there could be a high probability of the trade actually blowing through and trying the top tick and test the top end of the profile. And depending on how extreme, and we're going to actually see that in the trade example at the end of the video, but depending on how extreme that is, or how long it takes, because the longer the chopping is, the more extreme the blowout most likely be. Whereas if the chopping doesn't last as long, like maybe 10 minutes, it's not going to have as good of a blowout as chopping that happened over multiple fucking hours. And when you have multiple hours of chopping in a bell curve, the expected value of the trade is skewing into your favor if you time it right and you create an appropriate narrative. But so price action and profile structure are very much, you can't have one without the other. So they go hand in hand, but while they go hand in hand, they are both different separate components. And I'm building out context as the price is testing areas. Like, okay, we're approaching the bottom of this bell curve. It should blow out. Oh, there's no volume. There's nothing happening. The volume is dead. The volatility doesn't exist. So if the volume and the volatility don't exist, which right here, volume and volatility, they affect, let me actually redraw that. Volume and volatility affect context building. The red box called context building. So if we have high amounts of volume and volatility near the bottom of a fucking curve, well, there's a higher probability that might actually blow the fuck out. Whereas if it's not happening and we keep testing lower and the volume and volatility are drying up or it doesn't exist, then there's a high probability it could mean revert. But the volume and volatility may increase on a breakout, but then it could instantly slow down, or it could break out and create a reclaim riff and then come right the fuck back in. So it's very finicky shit. So context building is extremely important, because context building, and what context building is essentially is taking small things like techniques in the blue box and taking profile structure and price action in the red box. And when I'm constantly building out context and I'm just watching things pan out over time, I'm now creating a narrative over here. And when we create a narrative, that's how we can find a setup. But then we want to cycle back to actually using good techniques to get into the actual setup. So let's continue. Let's talk about, let's talk about, and that's the thing, tracking and profile structure both contribute to narrative. And what else contributes to narrative? Well, the blue box. So let's go ahead and do this. There you go. So now let's go ahead and talk about patterns to assist entries. So these are going to be larger channels, not micro channels. This could be on a 30-second chart, which a 30-second chart is pretty big. In my opinion, it shows enough of the session, but it also shows the essential noise. If you start to do 1 minute, 5-minute charts, you're dialing out too much context, too much noise is gone, and then you're not going to have it. You're just not going to nail cleaner entries, and you're not going to be scalping off of such a high time frame. I think it's very imperative that you do go down to a 3 to 1 second chart. It's going to be a 1 second chart if the volatility is extreme. And if the volatility starts to kind of like go away and volume starts to slow down, then we dial it back up to a 3 second chart. Or I do, at least. So we have bigger channels, bigger ranges, bigger reclaims. You can have reclaims, for instance, FOMC could just juice the market up, and then that entire 50 tick, 80 tick movement could be completely retraced. So that would be a bigger setup, a higher probability setup to actually really reel in a higher risk to reward trade where I can basically make more because the tick value is there. Whereas these techniques up here, the smaller techniques, they're not going to be really reeling in as many ticks. That's why it's imperative to use these to assist these trades here. So I'm trying to fucking point at this shit. It's kind of cool. So we also have blowout profile, which I will show the blowout profile in a second leg and the trade example at the end of this video. And then we have a hard V as well. So a hard V is essentially just when the market blows out of a mean or a bell curve and then instantly comes back into the mean. That can be used for context building. So I would definitely say that this stuff is used for context building, which again, context building is used to create a narrative. Okay? Now, the thing is, again, volume and volatility is going to definitely affect this stuff over here. Oops, let's do it. Make it kind of pretty. So, again, volume and volatility, it affects everything. It affects context building, it affects the narrative, it affects techniques, and it affects the patterns to assist entries. So yeah, volume and volatility, man, and it's constantly shifting throughout the session. Now, there is an average tempo at times. There's just a point in time when you should walk the fuck away. Like this last FOMC I traded, I didn't touch the fucking market because it was dead as fuck. And I waited for volume and volatility to kick in because I know that when it's dead, I ain't making shit because it's so much harder. It is crucial for day traders to have volume and volatility. And those of you that sit there all goddamn day long, you're fucking up because you're trading bullshit. It's best to get rid of the bullshit trades and actually take good fucking trades. So again, we can use these techniques to get into these. So we can use a combination of slip and mean reverts in the blue box up here to get into, say, maybe a bigger channel in the purple box. Obviously, we need to make sure we're tracking price. So I could definitely say that we could kick this red box back right here and bring it to the purple box because profile structure, price action can definitely affect what's happening and the context can definitely be affecting what's happening in the purple box with channels, ranges, reclaims, blowout profiles. And again, this isn't everything, guys. This is definitely the things that came to my mind. So there might be missing things or whatever. Hopefully this does clear some of my trading up. So yeah, that's when it comes to scalping, that's my brain is constantly basically doing what these red arrows are. I'm just like thinking about this and that and that and that. How's that align with this and this? Does this go with that? Are we, and then what's the volume volatility and how, okay, here we go. And that's how it's done. So it's that simple. Not really. That trading is obviously pretty difficult. And this is why This is exactly why it's going to take you years to get fucking consistent. Okay? So yeah, so we're using high probability techniques because those are super trackable because they happen all the time and they're on such a small time frame to assist into bigger patterns. And then, you know, that all feeds the narrative as well. I would definitely argue to say that this actually feeds the fucking narrative. So let's go ahead and go up in there and then boom, there you fucking go. So now that we've seen this, let's look at an actual A+ setup, shall we? Okay, guys, this is a trade, I believe, from Friday, if I'm not mistaken, which would be in the 5th. So anyways, let's go ahead and, right? No, it's from the 4th. Wait, what the fuck? Oh, it's Sunday, because it's fucking 2:24 in the fucking morning. Never mind. So it is from Friday. So, just before we get into this shit, guys, this fucking video is probably gonna take me like 10 fucking hours to make. Just shooting that whole fucking scene and editing and to get this picture done and shooting the scene with the red robe and just doing the video and editing the video and just shooting it. This takes fucking forever. And I'm probably only going to make $250 to $300 off of ad revenue from YouTube this month. So if you guys feel free, please donate to my coffee down below. Link in the description. I would appreciate that shit because YouTube certainly is not paying enough for me to actually want to sit here and fucking do this bullshit. I just enjoy being creative and doing content and stuff, but it's just not paying enough. So I would appreciate that, or subscribe and like the fucking video if you don't have any money because you're poor or whatever. That's cool. That will certainly help with the algo and all that bullshit. And then get more subscribers, more views, more ad revenue, hopefully. But again, this is a fucking another job, and to make $300 to post several videos per month is not fucking worth it when I can sit here and just trade and make a shitload more in 30 minutes than doing this fucking job. And this is why I'm going to eventually sell fucking content, because content is going to supplement doing YouTube, and then therefore those who buy the content, that'll make doing YouTube actually worth it because it's like marketing and advertising for that shit. So therefore this job would be worth it. And I do like doing this. It's not fucking worth it monetarily wise. So please donate. Because this is good shit, man. Anyways, let's get into this. So yeah, here is from Friday. So let's talk about the price action. This is a 30-second chart, right? So the price sold off and then it came back up, right? So this is the open. So in number one, high of day, and by the way, this is my daily report card. I talk about it in the actual coaching series. Again, I highly recommend watching the coaching series. This is the play of the day for me. So number one, high of day breached almost a full hour in after extreme sell-off. Sign of a neutral day. Okay. So typically, if that open gets hit, roughly 45 minutes to an hour, typically from my experience, and I don't have statistics to back this up, but typically the market starts to mean revert. Not necessarily go neutral. So it mean reverted up here and such an extreme fucking sell-off. So number two, channel being violated from sell-off number one. So right here, you can see a pivot 1, 2, 3, 4. There's a channel, a micro channel, and now it's not a perfect channel, right? And you don't need to get too finicky with that bullshit. But this is a channel down nonetheless, which starts to get violated right here. Number 3, extreme neutral profile being built. So you can see that this profile is being built. So this is the RTH session right here. The thing is, the session didn't look like, the profile didn't look like this up to this point. So I drew this, and I believe it expands all the way to here. But either way, there's a profile here, and the price action in this section spans several hours. In fact, number 4 is another channel, and this channel right here in number 4 went on for a full fucking hour. So now at this point of this channel being actually developed, this profile down here, no, we're not looking at any of the other profiles. This is more of a micro profile, if you will. I don't know what the fuck I was going to say. Yeah. So this profile was there as this channel was being made. The thing is, there's several pivots on this channel, but you don't want to hit them near the middle of the actual mean. Whereas number 5 is where the channel starts to reverse with another smaller micro channel. So that would be the equivalent of, you know, we're looking at a micro channel that is inside of a bigger channel, for instance. And then we have a bigger range or a bigger mean, if you will, in this section. So this is also from the top of 2 all the way to the bottom where this green line is. That's also a range. It's a bigger range. It's comprised of micro ranges, but it's a bigger range nonetheless. So now you're starting to see how these multiple techniques are fitting together. It is very important that we do get them to align. So you have a micro channel going up, and also that pivot near 5 bottom ticks. So you have the low of day. We don't bottom tick it, and this is a hard V. So if you guys want to know what this hard V is, there's one right here, and I actually took a long in there, and I took a nice little scalp off of that. But eventually, the trade comes back. I mean, I believe I pulled the entire trade. I can't remember, but that's a hard V right there. So, channel for an hour. This is the bigger channel, micro channel. And then we blow out. Number 6 is where I enter. So let me just go ahead and go down. So number 5, bottom tick with no extreme tape or selling. The upper mean was overly choppy. So this had a high probability of a pull-in, especially with a combination of no selling near lows and the mean being so heavy and thick. Number 5 eventually micro-channeled up. There were several micro-channels up and the bigger channel down, but number 5 was below the mean, whereas the other ones rotated on the mean. So there were areas where this started to channel up. You can barely just see it right here. That's right on the mean, or right on the point of control area, or right on the center line. Whereas this one was slightly lower. So when you're trading, it's never really a good idea to trade near the middle of a range or a profile because you're going to get chopped up. Whereas if you can get it on the edge, there's a higher probability of it actually coming in. Now, could this market have absolutely sold off? Yeah, it could have. The way the price action forms isn't set in stone. It's essentially anything could happen. And when you're trading, this is where a lot of traders fuck up. I think it's very important that you think in probabilities. Don't think in the sense of, oh, it's going to go here or it's going to go up, it's going to go down. Don't think like that. You do need to change your thinking up, and you should be thinking it could. Because when you start to think in the terms of it could, you're less likely to start forcing and pressing trades. So anyways, yeah, we're going to zoom in on this section here and then down below. So number 6, second leg blowout. Write-up will be done on next picture 6. 6 was also entry. Side note, most of the chopping was below the mean, so there was a high probability of a run-up to attempt a top tick or even VWAP. So if we drew a line, I'll attempt to do it. It's not going to be very straight, but let's try it. This isn't very straight, but most of the chopping, and remember I was talking about how profiles could be formed, like earlier in the video, it could be formed off of various price action. This is a really good one for me. Most of the price action was below. So most of this chopping was below the mean. Most of the chopping, and I mean, again, this line should be a little bit higher. Most of the price action was below the center line. Most of the price action was below the center line. There really wasn't much price action on the upper half of this really textbook looking curve, except for over here, but that was early on. So, and also we're getting a bottom tick in, and it's not blowing out. So since most of the price action is below the center line or below the mean, and we got a bottom tick in, and we chopped for several hours with a downward channel that is reversing with a micro channel, that's multiple factors of support, and all of that context building has created a narrative, and that narrative is there's a high probability A+ setup. When it comes to A+ setups, in my personal trading, because I've combed through a shitload of report cards a few weeks back, I noticed that all my A+ big hit wins, where I'm really making good big fat trades that aren't like scalps, those are created off of more complex things like this that have a shitload of narrative. You probably won't see this trade again. So I mean, it's good to kind of do a write-up on it, but this is not a repeatable playbook setup, okay? But a lot of the techniques that are all aligning and creating multiple factors of support and all feeding into each other, such as the bottom tick having really no volume or volatility, I mean, that's context building, which creates the narrative. And I have a video on context, which I really think is important. You guys should probably go watch that as well. There's so many gems on this channel. But anyways, just all these techniques and smashing it all together and creating a narrative and understanding that price over time will skew the expected value in your favor. For instance, this curve, this curve down here chopped for hours. So therefore, the blowout was a lot more extreme than if it, say, just chopped for this long. That move out may have not been that extreme. And also, what was nice is this really hard drive down from earlier in the session. That's sort of a higher time frame reclaim, if you will. So that is a bigger reclaim that I was talking about. So it's not a 3-second reclaim or whatever. But yeah, so there's just so much in my own personal trading that is just, everything is meshing and aligning. And when I just have that much shit mushing together, that's when it's an A+ setup. Now, don't get me wrong, doing a slip or whatever may be an A+ entry on a super small time frame, but it may not be going into an A+ setup on a bigger time frame. So I believe there's A's on the techniques and entries, but how does that fit into the grand scheme of things? So while the entries can be A's or aces or pocket aces or pocket kings, and you could most certainly get scalps off of shit like that. If it's not fitting into the higher time frame, well, then the higher time frame may not also be pocket aces, and then you're not going to get the real big move. So let's go into where we're a bit zoomed in here. So this is the same area. So we're looking at this section where number 4 is, number 5, and number 6. So where this circle is, it's super zoomed in on a 3-second chart. This isn't the auction vista. I know it says 1 second down here, but I added a 3-second chart as well to kind of really aid with context building. So number 4 is the bigger channel. Number 5 is that micro channel, and you can just see with this much more noise, this paints a better picture than the 30-second chart. It doesn't look like, it's really not telling me as much as it is down here. Because you could really get fucked up on this little channel. I mean, these are big-ass swings that you could lose a lot of money on something that seems so small up here. But anyways, what happens is this line down here is the bigger channel that took an hour to pan out. We obviously bottom tick down here, right there. And then the micro channel, and then we break out. And when we break out, like it gets real tight and pinned up. It breaks out, and then it runs really clean. And then it gets stuck right here, and then it runs real clean again. So in the specific environment we have now, typically when you have a blowout, most of the time it'll come back. More rare, or less common, I would say, not more rare, you get a blowout, it pauses, and then another blowout. This is a second leg. So when we were looking at this, we have second leg up here. So here's the second leg. So anyways, blowout, pausing, second leg. I'm not going to chase this because it is on the mean right here. I would have ideally liked it down there, but it was just too difficult to get. A nice, clean, precise entry. But what happened is there's this profile which expands from this bar all the way to this bar where number 10 is. And what happens is it created a nice micro bell curve. Do you see that, guys? So this is what I'm talking about, is small bell curves are used. There's so many of these micro auctions, these smaller auctions, these small bell curves are constantly being formed throughout the session. That's why I like to reset my profile, where this little small thing, it has the price action is going to be cleaner, and it's going to be easier to time than attempting to trade this larger bell curve right here that has the most random fucking chopping, and just trying to time this is almost fucking impossible. Whereas if you can really hone in and zoom in, you start to get a nice micro profile with really clean price action. It comes in, tests as the top, comes in, and then it bottom ticks right here, and that's where I start to go long. And I just hold it from that point forward, and I made like 57 ticks, but I held it on 8 contracts, so it was, I mean, I cut it prematurely. I should have held it to VWAP, at least part of it to VWAP, which I didn't. I ended up cutting it a little bit earlier before the other target, because I did fight quite a bit that I did want to start locking something in, because if this trade came back, that would have been bad for me. Not that I would have been like down or anything. It's just like I did get a little beat up because I came into the session scalping quite a bit, which I got up to $1,000 real quick. Whereas this 8-lot trade, it ended up pulling 5,700. It could have been more of a $8,700 trade. Should have held it. And most of the trades this session I was cutting for scalps up until this point. Now, I did try to get into some holds earlier, so I did get a little beat up. But I knew what I had on deck. And this right here is called a blowout profile, which is right here as well. So, yeah, that right there is, I'm like, oh, I know exactly what this is. Now, even though I don't like trading the middle of a more major profile like this, based off of all the other context and what was happening, for me, this was a good high probability setup. So guys, I hope you can now see a little bit more what's going on in my trading. And again, please donate to the coffee. I'd appreciate that. I mean, this is really rich material that you're not really going to find anywhere else. Yes, I know this was this hindsighty breakdown. I don't feel like going over the actual footage of the entry or anything, but that's not the point of the video. This is its own specific lesson, and that flow chart that we looked at earlier is the crux of this specific lesson. I like to do videos where specific videos are specific lessons, and that's what this is. This isn't to watch order flow or the DOM or whatever. But if we was looking at that, there was probably some slips or reclaims. There was other things going on in there that we probably used to further assist the trade. But that's how it's done. And again, this is multitudes of a lot of things I understand, all mashed together, all working together, and that's how you get the bigger trade. The same thing's going to apply to scalps, but obviously this specific trade just happened to have bigger time frame shit going on with it. Whereas that prior video that the YouTube subscriber, or my subscriber, I hope you're a subscriber, was commenting on, those were mostly just scalps. So all this higher time frame shit was not there to really assist, or the volume and volatility wasn't sweet spotting. This specific session had pretty good volume and volatility, I would say, as far as I can recall. So it was a bit more on the sweeter spot. So there's quite a bit going on when it comes to my trading. So again, I hope you guys enjoyed it. Please like, subscribe on the video and the channel, and I will see you in the next video.